Hey everyone, in this video, number 3 of the Guide to M&A Transactions, we're going to be discussing EBITDA and underlying earnings. So in the previous video, we discussed why EBITDA was so important. And I'll just quickly flick back to those slides. It's incredibly important because no matter what valuation method you do, either DCF or a multiple of earnings, they're both dependent on your sustainable EBITDA. For DCF, it's based on your underlying EBITDA modeled out into future cash flows and discounted back to a net present value. For the earnings multiple, it's a simple multiple of underlying EBITDA. So if your multiple is 10, it means that each dollar increase in EBITDA, you're getting an extra $10 in purchase price. So there's a very strong incentive for investment banks, advisors, sell sides, sellers, vendors, etc., to really maximize that EBITDA to the point where often many of the numbers initially presented by advisors are unsustainable. And what happens post-acquisition for many acquisitions is they find that the sustainable EBITDA that they've agreed to isn't actually sustainable at all. Maybe some of the normalizations were too aggressive and didn't pan out. Maybe some of the synergies were already baked in, or maybe the synergies promised to offset additional costs which they hadn't considered at the time. Or maybe there was some kind of one-off or non-recurring transactions like acquisition costs, but we actually need them going forward in an acquisitive business. So they aren't actually one-off costs that need to be factored in. So coming back to these slides, in this section, we're going to be talking in great detail about what is EBITDA, what is underlying earnings, why is it so important. So I've discussed just now with reference to the previous slides kind of why it's so important, because in most cases, it has a multiplicative impact on the purchase price, right? If they can save just $1, if the sellers can save just $1 in EBITDA by cutting $1 in costs, they're going to get 10 times that or 20 times that, depending on what your multiple is, in purchase price. So there's very strong incentive to adjust EBITDA. Now, how this goes about in practice, and usually there's an FTD process where an external advisor will come in and they'll compare management's EBITDA numbers, they'll compare the buyer's EBITDA numbers, they'll compare the two, and they might propose some of their own adjustments that they've identified during due diligence. So the aim of the advisor in this process is to come in with an independent view, form an independent opinion about what they think sustainable EBITDA really is. And then from there, it's really just a negotiation process in terms of, which of the sell side adjustments are we going to accept, which of the buy side adjustments are we going to accept, and which of the advisor's adjustments are we going to accept. So here you can see on the right, here's an example of what that might look like in practice. So a Big Four or other accounting firm has come in and they've undertaken an analysis. They will prepare multiple years of EBITDA because the normalizations typically apply across multiple years. And it's very important to have that run rate because, of course, you're going to want to see what the due diligence growth rates, both in revenue and EBITDA, were as well, because, if EBITDA is accelerating unrealistically, it's often a red flag. And if you're buying the business on the basis of high growth, you want to see that continuing in the future. So it's important we do it not only just on the deal year, but of historical years as well. So in this case, you can see EBITDA is reported. So this will be whatever was directly from the management account for the historical periods. And then we start off with management adjustments. So these are what the sell side have proposed as adjustments. And keep in mind that management's incentive is to maximize EBITDA as much as possible. So they're probably going to be more aggressive than, say, what the advisor might put forward, and definitely more aggressive than what the buyer would put forward, who of course has an incentive on the other side, which is to reduce EBITDA and therefore reduce the purchase price. Management can comprise of the CEO, senior management, and also the sellers as well. And all of them would have some sort of incentive in selling the business for a high stake. The executive team often have an LTI or own shares in the company, and therefore would benefit from the sale. And of course the sellers, the shareholders, would also obviously benefit as major shareholders. So a couple of examples here that they've provided for management adjustments. So they've excluded private company expenses. So they've said, we've got some personal expenses running through the company, whether that was maybe the founder had a car expense in there, maybe he had his own personal telephone, personal flights, maybe he ran his children's school fees through the company. That might be a legitimate adjustment, but we'd want to go in and see the detail as to why that's private and be very certain that it's not going to continue going forward. Next is redundancy costs. I'd probably be a bit more hesitant around this one because it's often promised in these deals, especially trade deals. A trade deal is when you've got a trade buyer. For example, if you are in the, let's choose a random industry. Let's choose consumer goods. Let's say Johnson & Johnson are buying a particular brand of medicine. That would be a trade sale because they both are businesses which operate within that industry. That's what their specialty is. That's all they do. As opposed to, say, a private equity sale, which is, the company's just looking to flip it. Trade sales often get a better price because they're able to sneak in or negotiate probably more aggressive normalizations. For example, if you've got a trade company selling to another trade company, you've probably got a duplication of, say, the CEO, CFO, senior leadership team in combining them. So a lot of what the investment bankers and sell-side advisors do is they say, oh, you don't need them, let's adjust them out. It makes sense on the surface, but what we fail to take into account is, well, given this business is essentially doubling in size, there probably is a demand for extra headcount. And what often happens is we don't actually see the termination of employees like was pitched by the investment bankers. The other risk is the pitched redundancy costs on the basis of, they're just non-recurring roles. A very common one in this instance is acquisition roles, like if they've got an M&A manager or M&A director, or if they've got an integrations manager, integrations director, etc. And they say, you don't need it because they're only related to acquisitions and they're temporary. But most business continue to be acquisitive post-acquisition as well, so they're not actually redundant. So very common issue. Or the third scenario is those yes, you do get the cost savings, but they are just offset by additional costs somewhere else in the business because of that extra scale or integration, which you haven't anticipated, and you actually don't get the savings as a result of that. So this is a fairly simplistic one. I mean, in reality, the management will be proposing, like, depending on the size of the business, the complexity, could be from 5 to 50 adjustments. This is obviously a very simplistic view we've got here. So then you'll get to your total EBITDA. They'll call this your EBITDA as adjusted by management. So this is their view of what sustainable EBITDA is. But during due diligence, the advisor, let's say Deloitte's come in and said, okay, well, we've also identified these adjustments. These will often be much more in the detail relating to accounting adjustments. For example, you've got one here, unusually high level of bad debts. So again, keep in mind what we're trying to do is not just normalize EBITDA for 1 year, but figure out what is the sustainable level going forward. And so you might need to look at 3 years of averages and say, okay, that's probably what you'd expect going forward. We're just valuing it off a particularly unusually high year or unusual year. So it's not fair to value that at 10 times off that. We want to know what it is over the next 10 years, right? That's what we want to value it off. Next, one-off royalties received. So it's okay to normalize any kind of one-off, non-recurring, or out-of-the-ordinary kind of costs. That's okay. And then you've got another kind of accounting-related policy, because I think a lot of people overlook this, especially if you're going into investment banking, you're not from an accounting background. People who've started off in Big Four accounting or other kind of corporate finance roles will appreciate that accounting actually does play quite a big role in EBITDA, because you can change one policy, for example, revenue recognition, and it has a huge impact on EBITDA. And if companies getting ready to sell are planning years in advance, these are the things that they're going to be thinking about. Like, put yourself in their shoes. If you own a business and every dollar you can save, either in cost savings or additional revenue, regardless of whether it's real or not, if it's just an on-paper adjustment, you're going to get 10 extra dollars. Like, you're going to be very incentivized to go out there and make these adjustments. All right, and then the final section, which is EBITDA as adjusted by management, including other potential adjustments. So we probably have in this situation, as opposed to as adjusted by management, including other potential adjustments, because these are probably just management proposed ones, which are just maybe adjustments, which are the kind of the ones up top are the definite adjustments, and these ones are kind of like the ones which are 50-50 or grey areas, which will form a lot of the negotiation. They might accept half and meet somewhere in the middle. But typically what you'd also see in this section is at least in the due diligence report, is kind of the seller proposed adjustments as well, if they've put those forward. Okay, so let's moving on. So quality of earnings. So you might have heard this term before. It's used often in a transaction environment. It's used to describe EBITDA. It's another way of saying sustainable earnings, essentially. So it's not just your EBITDA, but it's your sustainable EBITDA. So it can be described as reported earnings of a business reflecting the underlying economic characteristics of its normal recurring operations. So that wording gives this scope to not just do one-off adjustments, but actually look at how it trends relative to kind of longer term averages in the business to make sure we're not kind of adjusting off a kind of peak year or an unusual year. And that can go both ways. I mean, expenses could be abnormally high, or they could be abnormally low as well. So a couple of examples that we kind of look at for normalization. So number one, non-recurring one-off exceptional items. So this could be redundancy costs, could be litigation, could be disposal of M&A costs, profit on fixed asset disposals, provision charges. Like all of those are fair because you wouldn't expect to really see them again going forward. But you really do need to be careful that it's not just the investment banker saying, yeah, it's not going to happen again, and then you buy the business and it continues to happen. You really want to do due diligence on this and make sure that it is genuinely non-recurring. Next is the changes in nature or scale of the operation, so acquisitions and disposal. So this is, I mentioned this one before. It's a common one put through by sell side. They're saying, particularly in kind of acquisitive roll-up, highly acquisitive businesses. They'll pitch this, and this is how they report in the statutory accounts as well. So even to shareholders, even by auditors, they'll put this below EBITDA and say, it's a non-recurring, it's integration related or acquisition related, and therefore it's not part of our quality of earnings. Again, just be very careful and make sure that it actually is what they say it is. And if you are an acquisitive business, then what's the likelihood that you'll need those roles going forward? Probably high. So I would probably argue in those situations that you'd want to keep those in. Next is one-off accounting adjustments and non-cash items. For example, wind down of provision. If there's a write-off of bad debt, things like that, you need to look at them. Again, you'd probably see them as one-off in the accounts, and it's another good idea when you're doing kind of if you're getting into if you're doing due diligence, or if you're an investment bank preparing the sell side pitch, you really want to get monthly accounts. Annual accounts aren't good enough because you really want to see the timing of these adjustments on a monthly basis over 3 to 5 years in the past at least. That gives you a good sense of kind of the timing of these, the regularity of these items. And then changes in accounting policy, which kind of links into the first one, but this is really when you change on a regular basis going forward how you account for something. So you really want to make sure all of the numbers in the account that you're looking at are prepared on the same basis. You can't have a couple of years on one policy or one method of accounting for and other years in others. You really need to be like for like consistently throughout. So those are the 4 tenets of quality of earnings. It's really just looking at what we could expect the earning to be if we bought the business in the long term, excluding kind of one-off non-recurring things like COVID or whatever. All right, so the next term we're going to discuss is underlying earnings, and you might have heard this term as well. So underlying earnings are understood as the amount of earnings which reflect the economic characteristics of the normal recurring operations of the business. Reported or projected earnings are therefore adjusted to eliminate the effects of items which are not considered reflective of the normal ongoing operations of the business, including the examples listed above, in an attempt to estimate the true underlying earnings of the business. Underlying earnings is sometimes referred to as normalized earnings. So, they're all very much used interchangeably. Quality of earnings is very much the term specifically used for the valuation of the business. That's the EBITDA that you would use for your final calculation of headline purchase price and equity value. Underlying earnings is very, very similar, and no one would fault you for using this term interchangeably with quality of earnings, but it's probably more of a longer term view of the business and saying, okay, this is our baseline EBITDA, which we can expect going forward. It's our normal recurring operations. Why is there a difference? The difference between the two terms is so small, but one example of how they might be different is, for example, you might allow an adjustment in for your quality of earnings for the purpose of valuation of the business, which you wouldn't expect to go forward in your underlying earnings. So this is probably just a concession in terms of your actual valuation of the business. Aside from that, they're essentially interchangeables, I should say. Okay, so let's talk about why quality of earnings is important. And we've kind of touched on this a little bit in previous slides because it has such a big impact on the valuation model. But to break it down from a different perspective, we can look at it from two ways. Number one, it's important from the perspective of looking at the business in the past. And it's also, in other words, allowing us to understand what are the true value drivers of past performance, excluding kind of any extenuating factors which might, hide the true value drivers of past performance. For example, COVID, right? Look at 2020. If anyone were to look at 2020, they'd be like, okay, well, did this business decline because of poor operation? No, it didn't decline because of poor operation. It declined because of a terrible world event which no one saw coming, and in some industries you have absolutely no control over, and it just, for example, the flight industry, that's just going to decimate your business. There's literally nothing you can do except kind of cost management and waiting it out. We need to normalize things like that out so we can really go down and say, okay, what are the drivers of the business and how well are the kind of managers of this business controlling that? Number two, and I'll do a deep dive into these in a moment. Number two is from the future perspective. And that's probably more referring to, okay, what are we going to pay for the business? Because going forward, our earnings are going to be on this basis, and therefore we're happy to pay on that basis. Okay, let's do just a quick deep dive into the past, why that's important. So by adjusting out historically reported earnings, and this is talking about, the past 3 years of earnings minimum, right? It helps us to identify what the underlying earnings of the business, what the trends are, and what the drivers are. And by understanding what those are, we're better able to understand the business that we are acquiring, right? Because it's not just about what is the baseline valuation EBITDA that we're buying it on. We also want to know, okay, how have they performed in the past? How confident are we that management can continue to grow that growth? How sustainable is the growth? And what are those drivers that we can pull ourselves? And all of that, it's really critical to understand the underlying numbers without any kind of influence from other extenuating factors, so we can do that analysis on the business. Number two is the future, right? So as we've been through in previous chapters, buyers typically determine the price range for a target business using a valuation model, and there's typically two kinds, and it's either going to be DCF or a multiple of EBITDA, or in some rare situations, multiple of revenue or other. But in each situation, we're going to do at least one valuation model based off EBITDA. And that's going to impact the valuation that we're paying. And the risk is, if we get that EBITDA wrong, we're most likely going to vastly overpay for the business. We're not going to get a good return either to our investors, return on capital, or, if we're operating as a private equity firm, for example, it's going to severely impact our kind of fund return and then our kind of prospect of raising future capital as well. Okay, so how do we measure quality of earnings? I think we've kind of touched on this a little bit already, but this is really going in a little bit into the kind of high-level accounting overview of, how do we get to that quality of earnings? Well, the first thing to know, we talked about in detail kind of how do you adjust EBITDA, but I guess a high-level question is, what is EBITDA? How does that fit in with the P&L? So we mentioned in an earlier video, EBITDA is earnings before interest, tax, depreciation, and amortization. So your typical income statement, while it won't be as simple as this, can be categorized into all of these lines. You've got your sales or your revenue, your cost of sale, your COGS, your gross profit, which is the difference between sales and cost of sales. You've got your expenses. These are just your general operating expenses. Then you've got your depreciation. You've got your amortization. And you've got your operating profit. So your operating profit's essentially your gross profit, less expenses, less depreciation, less amortization. And then you've got interest down here. Then you've got tax, which is based off, you calculate tax based off your operating profit less your interest expense. And then the difference between your operating profit, interest, tax is equal to your net profit. And that's the number that's reported in most statutory accounts, and it's very easy to get. We did a couple of Googles before about looking at the price earnings multiple, which is based off of net profit. And we also discussed in an earlier video why it can be quite misleading to use net profit, because it can be so different company to company. Some companies have very high depreciation, have high amortization, including of intangibles, which is completely irrelevant in terms of evaluating a business. You've got some businesses with a different tax structure. You might have some which are, for example, Apple, they've got an overseas arrangement with Ireland where they only pay 8% tax, and you're comparing that to, say, Rio Tinto in Australia paying 30% tax. It's just, Rio Tinto might be a better business, but you wouldn't know because it's being distorted by this tax, right? And then you've got interest as well. So you might have some companies which have, maybe fully funded with equity and therefore have no interest on their P&L, right? That's going to show them in a more favorable position than a company which has high interest, even though the underlying business itself, ultimately what we care about is, our revenue, our cost of sales, our expenses. That's primarily what we care about when valuing a business, because these are the cash items. And as Warren Buffett says, cash is king. So why have we laid out the income statement or P&L in this fashion? Because, if you just get a standard management accounts or stat accounts, they're not going to be laid out as simply as this. They're going to have a lot more detail. So we're going to have to actually manually allocate this in Excel into one of these categories. But the reason we've split it out is because expenses, these are all cash items. Depreciation is a non-cash item. It's just a accounting journal, right? It's just saying, okay, my asset is worth less, but there's no actual payment as a result of that. Same with amortization, because that's also in relation to intangibles as well. And interest and tax, as we discussed before, can be distorted by various structures, and it's not really a like-for-like comparison, so it's not really fair. So the reason we've put it out like that is so we can quickly calculate EBITDA by going sales, less cost of sales, less expenses. There you have our EBITDA. So that's just general EBITDA. And then, of course, after that, we also need to normalize it for any non-recurring adjustments to get to our quality of earnings, as we discussed in previous slides. So this is a little bit of repetition, but why do we take out each bit? I think we've kind of covered it. So interest, based on the buyer's capital structure and financing arrangements. This will change entity to entity. Some businesses will have all equity. Some businesses will have all debt. Some will have a mix. Some will have negotiated lower or higher interest rates. So if you really want a standard universal comparison between any given company, you need to take it out, right? Because it's not consistent. Same with tax, because some companies do tax planning. It's also often considered part of the cost of capital, which feeds into this. It really depends on the buyer's capital arrangement. The reason why it's considered part of the cost of capital is because you get you get a tax deduction for interest. So if you have a business that's loaded up on debt, you'll get a tax deduction. Whereas if you have a business loaded up on equity, you're still going to have to pay the equity or the cost of capital of equity, but you don't get a deduction for tax. So that's another reason. So, and then, tax planning includes kind of, different tax rates between countries. I gave the example of Apple paying 8% in Ireland versus, some companies paying 0% in, say, the Cayman Islands versus 30% in, Australia. Depreciation, why do we take it out? Because it's non-cash. So these last two items, we take them out because they're non-cash. We primarily care about cash items. The reason is because if you're going to get the money in your bank, that's what matters. You can write whatever you want on a P&L. You can say, I've written off the value of my operating business in China. It's now worth 0. Does that impact what's in your bank? No. Does that impact the amount of money you can pay out to shareholders? Maybe, but you still got the cash in the bank that you can pay out. There's ways around it. All right. Or I can write it and say, okay, I'm depreciating my asset. It was worth $100,000. It's now worth $50,000. Does that impact the amount of cash in your bank? No. Does that impact the amount of dividends you can pay out? Maybe based on your net profit, but you can still pay it out. There's ways around it, right? And same for amortization. But it's the difference between depreciation and amortization. Amortization is typically based on intangible assets. Again, why would I care about that? It's even less of an impact because it's not even a real, it's at least with depreciation, if I've got, plant and equipment, I know, and I've got 10% effective, depreciation, I know that in 10 years I'm probably going to have an outlay of to buy a new machine. So it might be $1 million or a couple $1 million down then. So I know that in the back of my mind. With amortization, it's intangible assets. I'm not going to buy a new intangible asset. It's literally no impact on my on my valuation or cash in the bank or dividends or anything really. So yeah, To summarize 3 tenets of it, it helps us strip down to get the naked profit. That's number 2. It's easily comparable, right? Because we're taking out the things that change business to business, and we can compare against any business in the world, regardless of where they are, what industry they're in. Typically, we can compare them quite easily with EBITDA. And then finally, it's a good proxy for operating cash flow. Look, it's not perfect, but it's decent. It's gotten a little bit worse, as I mentioned recently, with the new standard IFRS 16, because that takes out leases. And there are a few things you need to look out for, like capitalized costs, including research and development and labor costs if it's a software company, and also just watching out for that IFRS 16 lease cost. But aside from that, it's pretty close to cash flow before tax, right? So it's pretty close. So what are the limitations of using EBITDA? Because it's obviously not a perfect measure. I already named 3 examples of why it's not perfect. It's, capitalized costs, R&D, IFRS 16. But, these are the other kind of limitations, because at the end of the day, it's still based off of, your accounts. And because it's based off your accounts, it's still subject to the application of accounting policies. And anyone who's an accountant will tell you that accounting policies can very materially impact what it says in your accounts without actually, it's sometimes just a on paper adjustment without actually any change in the underlying business. So something to be very careful about. And we'll cover a lot of this once we get to the videos in the technical accounting course, really touching on those fundamentals. Really important to have a good fundamental understanding of accounting, because if you don't have that, then you don't have the central tenets to build up to those higher level skills. M&A being one good example. Understanding those tenets and understanding the basics of accounting will really help us understand the kind of the risks, in this case, the risk of using EBITDA, but also when you're looking at any business in an M&A acquisition, understanding where the risk could be, where we could be potentially overstating EBITDA. So it's really important to understand that. So that's probably the main other, aside from the 3 I mentioned earlier, management policies, estimates, and assumptions. Basically just exposure to accounting policy is the key risk of using EBITDA. But equally, that's also applicable to any other multiple, like revenue, based on EBIT, based on net profit, even worse so for net profit. So just to deep dive into this a little bit more about the exposure to kind of the impact of accounting policies. So first of all, common limitation of underlying EBITDA. Number 1, the impact of accounting policies in practice. So not all revenues and costs are cash, and therefore accounting policies in practice will impact EBITDA. EBITDA is not a GAAP measure, and areas of concern relate to changes in accounting policy, the use of and changes in estimates, the degree of consistency with industry norms. Number 2, bias may have a significant influence. So quality of earnings adjustments to estimate underlying EBITDA may be highly subjective. In order to seek maximize the price achieved, vendors tend to be quick to identify positive adjustments, but not negative adjustments. This is something we've kind of covered quite a few times in the videos to date, and including this one. But I think one thing which we haven't mentioned, which I think is important, is that the buyers aren't as familiar with the accounts as the sellers. I mean, the sellers have been looking at these accounts month on month for, several years, in some cases decades. They know the ins and outs of the accounts. They know the timing, they know the phasing, they know the accounting estimates and judgments. They know all the kind of hairs, everything under the rug. The buyers only have a very short amount of time to be able to identify it, and they're heavily reliant on the available and quality of information provided by the seller and the quality of the due diligence provided, which is often within a very short period of time, say 4 weeks. So it's a very, very difficult process, and I think a lot of mistakes are made in this process, which the buyers are exposed to. Yes, there's warranties and indemnities, as we talked about in the previous video, but at the end of the day, to be able to claim under warranties and indemnities, it must be above a certain amount, and we'll talk about this later. It must be above a certain amount. It must be collectible. Like if the sellers have run away or don't have enough money, have gone bankrupt after the sale, you can't collect it. And finally, if you're doing some sort of kind of joint venture where maybe the person or people you bought the business from are still in the business, it makes the going forward relationship very awkward. So yes, people often say to me, yes, we've got warranties, indemnities as the excuse, but in my view, it's not really an excuse. And then finally, there is no such thing as steady state. So most businesses are in a state of continual change due to many internal and external factors, for example, acquisitions, disposals, impact of fluctuating commodity prices, exchange rates, etc. So, and this ties into the point before about really knowing and understanding the true underlying business. The sellers might know it, but the buyers are at a significant disadvantage. And, that's just with a consistent business. That's just knowing the ins and outs and the kind of the risks of the accounting and the timing of the accounting. That's before we even take into account the fact that most businesses are subject to continual changes. You might buy a business on a particular investment thesis, and it's no longer relevant, right? You might see a business that, it's growing rapidly, and then all of a sudden the industry changes, or maybe some of the contracts die out or wind down faster than expected, or maybe the international expansion plans that they promised haven't eventuated, and all of a sudden, you've bought a dud business essentially. Okay, so here's just a couple of other points talking about the limitations of using EBITDA. So number one, risk is not reflected. So I think this is a good point, and it ties back to that initial analysis we looked at when doing the comps analysis. So a single measure of underlying EBITDA, decent universal measure, but that's only one side of the story. It doesn't tell you kind of the growth rates of the business. It doesn't tell you the risk of sustainability of that revenue, of that growth. It doesn't tell you about the risk of, change in cost structure. It doesn't tell you about the exposure to kind of, change in business model or change in structure, loss of key staff, how critical those key staff are to the sustainability of the business. That's just a handful of things. There's, at least 100 possible other risks. So EBITDA is just a single number, but, a sensitivity needs to be performed, and models need to be undertaken with a range of different scenarios: upside, base case, downside, with different model assumptions to really understand what could go wrong, what's the upside, but what could go wrong, right? And are we comfortable if that does happen? Certain excluded items still affect value. So capital expenditure, or CapEx, and working capital requirements affect future cash flows and therefore value, but are not included in EBITDA, and they therefore need to be considered separately. So we talked about in earlier videos how we value the business, so it's a multiple of EBITDA. And I've also hammered home the point that we really primarily care about cash flow of the business, and that EBITDA is a good proxy of that. But if you've ever done kind of a cash flow report or analysis or model, three-way model, and we'll cover all this in later videos, you'll know that, operating cash flow, yes, but we also need to take into account, is there CapEx requirements? Because that's going to drain our cash. What about working capital requirements? We need to model that out as well. So these are all things we need to model and also understand the risks and expectations, and also do our significant due diligence on these areas as well, not just on EBITDA. Next point, complete information is seldom available. So I mentioned earlier that, the buyers are at a disadvantage because they don't know the business as well. They're on a short period of time to do due diligence, often 4 to 6 weeks. And it's really dependent on the quality and completeness of information, because if you're doing DD, yes, that sounds great on paper, but what happens if the sellers don't give you, monthly P&Ls, or what if they're missing a year, or what if they aren't available to answer questions? You can do your DD, but it's not going to be comprehensive enough for you to be able to identify all the risks. So it always remains a concern that adjustments may not be complete. It's always a risk that, you will carry in a deal, but particularly on tighter time constraints. And then finally, there may be one-off events in future. So there may be a number of items which have been adjusted for in underlying earnings as being one-off or exceptional. But if a number of these items arise in each period, there may be an argument that these are not really one-off items, but merely normal events that arise in the course of the ongoing operations of the business. And I've mentioned this a couple of times now. I mean, you just got to be really careful, particularly when you're looking at, proposed management adjustments, particularly in this section down here where it's probably the more aggressive ones, and just really be thorough and be skeptical and question every adjustment, particularly the ones we're saying, this is non-recurring, this is redundancy. Well, they kind of have to prove that it's non-recurring an adjustment. they're going to try and put as much in there as possible. They're going to try and, in many transactions, they're going to try and put in recurring costs and say they're one-off. So you really got to be careful with those. Okay, so financial interactions of adjustment. So this kind of really is why it's important to have a good understanding of fundamental accounting, be able to model, in particular do a three-way model, because then you really understand how does each item interact with each other. Because if you've done a three-way model, you'll understand that an adjustment on the P&L side is going to have an impact on the balance sheet side, most likely, and is going to have an impact on the cash flow side, most likely. Obviously not in every situation. For example, depreciation is going to impact your P&L, right? Because it's going to be an expense. It's going to impact your balance sheet because it's going to be accumulated depreciation, but it's not going to impact your cash flow in that particular case because it's a non-cash item. But, a lot of other things are, right? Collection of trade debtors, going to be a cash item, right? Sales, not necessarily going to be a cash item, but it would be a balance sheet item if it's moved to a trade receivable because it's you owe me. And then when that is collected, then it goes to cash flow, right? So it's really just understanding all that stuff, and it is a little bit harder than it sounds. So why is this important? Why is this relevant to M&A? Well, number one, help you understand the underlying business. But, each underlying adjustment that we're making in that EBITDA calc could impact other areas of the business, including working capital or capital expenditure. So it's important to keep this in mind. And it's, given some of our purchase price is going to be determined on based on some of these. For example, we might adjust EBITDA for one item and our business valuation increases on that as a multiple of that. But we forget to adjust working capital. But, at the end of the day, when we do our completion accounts, there may be a purchase price adjustment for working capital outside of normal working capital. Or there might be a cash adjustment for CapEx, right? So it's just important to understand these. So here's 3 scenarios that we're going to go through so we can kind of just really understand and visualize what are some of the financial interactions of some of the adjustments we might make. So in example number 1, Company A offers one-off 3 years interest, free credit for customers who buy before Christmas. So the resulting boost in sales leads to EBITDA up, right, because they're getting more sales, stock down, right, because they're getting less stock, so lower working capital, debtors up, unless it's outsourced or factored, right? So there's 1 EBITDA impact, 2 working capital impacts. Scenario 2, Company B revamps its flagship store for Christmas every 5 years. Every 5th year, investment leads to EBITDA up, right, because we're probably going to get more sales coming in. And CapEx isn't going to impact EBITDA. CapEx is not a P&L item. It's a balance sheet and cash flow impact. But creditors are going to be up, so it's going to impact your working capital. And CapEx up, so this might be a kind of a net debt or net debt or cash adjustment when they actually do spend the CapEx. So this is something that if you knew about that, you can model that out in your analysis. It's going to impact your future cash flows, isn't it? And therefore your DCF analysis. But if you forget that, it's going to materially impact your DCF. Also, if you know that they did a revamp 4 years ago, and you're looking at the investment banker or sell side's kind of pitch book, and they haven't included this CapEx spend, you could go, okay, well, this is probably a missing item that the investment banker should have included, or probably knows about and deliberately excluded. We're going to put this into one of our own management adjustments, and that's going to impact our purchase price, right? Because we're going to put an adjustment in here, a provision in the net debt adjustment, so we have enough CapEx spend for the flagship store next year, and we're not kind of paying the full purchase price and then on top of that paying extra CapEx on top of that as well. And then number 3 scenario, Company C decides to outsource the widget manufacturing to India. Well, I guess we need to consider, is this going to result in EBITDA going down or up? You might get some cost savings from that, but what's the temporary impact? You might also incur some additional costs, right? Which would be good from the buyer's perspective, but if you're now on the seller side, you might be going, okay, well that's a non-recurring cost we want to adjust out. But on the kind of the working capital side, stock down because you're no longer going to carry a lot of inventory on hand, right? It's all going to be in India. So what that's going to mean is potentially your working capital adjustment, if you haven't taken this into account in agreeing what is your normal working capital, you might get to, at the time of completion, you haven't adjusted into and this is from the seller's perspective, you haven't adjusted it into your normal working capital. You now realize your net working capital is significantly lower than your normal working capital. It's going to result in maybe quite a material adjustment to the purchase price. So it's just more, there's no hard and fast rule here, but it's really just about understanding the fundamental tenets of accounting and then thinking about each situation about the business, really understanding the business, the history of the business, and that's why kind of normalizing and really understanding the drivers of the historics is important for this. And then thinking about this big picture, what could be the impacts on EBITDA? What could be the impacts on working capital? What could be the impacts on CapEx and an adjustment to purchase price? And then understanding all of that and linking it back to our original understanding about how a purchase price of a business is actually adjusted with your impact on EBITDA is going to have a 10 times impact or 10 times multiplicative impact on your headline price. Net debt is going to be adjusted, but a 1-for-1 adjustment. And working capital may or may not have an adjustment. It's really dependent on what you determine what you're in the SPNA and also what you determine your normal net working capital to be. And also finally, CapEx may or may not have a 1-for-1 adjustment depending on if you can negotiate and include that in your SPA. So a lot of different kind of points and tenets there to understand, but we're kind of slowly picking up each kind of frame of the framework so that you've got a holistic overview and how each bit leads to another bit so that you can be a very competent, capable employee and link all of this together to make effective evaluating decisions and judgments for your clients, your boss, your colleagues, etc. So how does work on quality of earnings help? So this is where, investing in due diligence is expensive, right? You can spend $200, it obviously depends on the size of the deal and constraints and who you're using. A small DD could be $150,000. An average size, kind of mid, probably still in the smaller size SME is probably, $250,000. Plus you got to pay for, tax due diligence, if you're doing commercial DD, you got to pay for that as well. And any kind of other industry specific or integration DD, that's going to add up. For some deals, especially the large deals, the larger the company, you can start, timesing 2 all of those costs. You're talking millions of dollars in DD, and it sounds like a lot of money. And my recommendation would be that DD is usually worth its weight in gold, because if you think about the original principles that we talked about, where understanding how valuations are structured, where each dollar savings has a multiplicative impact on purchase price, and if you haven't identified kind of net debt adjustments, like maybe you haven't identified a tax issue, or maybe this company's been underpaying its staff, the value of the business, we're talking about many millions of dollars. You might spend $1 million in DD, you could save yourself $10-20 million in purchase price or even more. So it's definitely worthwhile. I wouldn't skimp out on DD. Probably the only thing I would skimp out on is maybe on investment banks and sell side, just trying to avoid that. Obviously if you're selling your business, I would try and engage them and do an auction process because it'll maximize your sale. But if you're from the buyer perspective, they're going to charge a percentage of the exit price. I would spend as much as you can on DD, like, your big 4 accounting, your commercial DD, if you're doing, private equity investment, and not a trade sale. Your tax DD, very, very important. And maybe an industry specific DD. That one's optional. But just really spending much money on that, so you really understand all of the risks, all of the potential adjustments, and having as much ammunition as possible for your quality of earnings adjustment. So you have as many adjustments to go back to the seller and say, we want to adjust for this, we want to adjust for this, and this. You might not get all of them, but at least if you cut back to half of them, you're still going to be in a much better position than you would have if you didn't do the DD and uncovered all of these adjustments. So I mean, here's just a very kind of like high level visualization of what that might look like. You've got your vendor adjusted, vendor is the seller, is this blue line. They're saying, okay, well, I think the EBITDA based on my normalization is this. Obviously, they're going to have the most aggressive view on what EBITDA constitutes. The reported EBITDA is what's in their accounts, right? This one down here. Obviously going to be the lowest because, reported EBITDA, it doesn't, includes all of the costs that, are non-recurring, that we might have synergies on. It's got all of the costs that you would report regardless of whether they're in sustainable EBITDA or not. Buyer adjusted EBITDA, they've got an incentive to get it as low as possible. It's typically not going to be lower than reported EBITDA because that's already got a bunch of the expenses in there, but it's not going to be a huge amount higher than what the reported EBITDA is on average. And there's generally quite a big gap in between buyer and vendor adjustment. You might even have a third line, which is kind of like your advisor EBITDA, somewhere in the middle. But the aim is to kind of meet them in the middle somewhere, negotiate down, and just agree on what we think the quality of earnings is. And that's kind of where that difference might result in between these two terms that we discussed earlier, quality of earnings, underlying earnings. To get the deal done, you might need to give a little bit of headway, which you think doesn't actually factor into your underlying earnings going forward, but it's merely just a little bit of a premium just to get the deal settled and stop it from falling over, provided your modeling and your forecasts still stack up. You always want to do that. You don't want to just pay out of your nose. Any decision needs to be data driven. You need to have modeled it out and say, okay, we're adjusting the purchase price to this. Our internal rate of return is going to be this. Our money multiple on investment is going to be this. But we'll talk about all of that later and what that means. Okay, and then just finally, to summarize everything we've talked about, why is it so important to get it right? What is at stake? I guess before we get into the detail, just to again recap, it's really important to get the value right, both from two perspectives, right? So from understanding historical earnings, so we really understand kind of the value drivers of the business and the trends of the business, so we can make an informed decision based on that, right? Because if you've worked with kind of historical numbers before, you realize that if there's just one kind of number in there, large number that you might have missed, that's a non-recurring item, or it can make the growth rates seem way different to what they actually are. You're talking about the business is growing at 4% a year versus, or 4% CAGR, I should say, versus 1% CAGR, right? You might buy the business at 4% CAGR, but you're not going to buy it at 1% because it's weak growth. You want a high growth business. So that's one point from understanding the historical earnings, and the second point is around price, right? So it's important to get it right because we're paying on a multiple of EBITDA in most cases, or if we're doing a DCF analysis to understand our range, right? It has a similar effect because you're forecasting all of your future EBITDA, and if that EBITDA level is too high to begin with, you're forecasting out 10 years of EBITDA. It's going to have a multiplicative impact as well. So yeah, really important to get it right because it just has such a big flow-on impact onto the purchase price. If you get it wrong, right, it destroys value. So it doesn't allow you to understand what the trends are. You could buy a business which on the wrong information, as I mentioned. We could make a low growth business look like a high growth business. And the executive team, the board, they need that information to make a informed and accurate decision, right? And then finally, if getting it wrong on the price, as I mentioned before, we risk paying too much, the risk of losing value through lack of understanding of value and uninformed negotiation of price. So that's why it's really important to get your quality of earnings right and really understand every part of the business so we can get our baseline EBITDA and our underlying EBITDA correct. So that's the end of the video. In the next video, we're going to be discussing net debt, why that's important. I think from my perspective, most important is number one, EBITDA, because it has that multiplicative effect. Number two, net debt, it is a 1-for-1 adjustment. And by that I mean if there's a $100,000 tax liability, we're going to include $100,000. We're not going to include 10 times 100, right? Like we would if it was EBITDA. That's why it's much more important to get EBITDA right, but net debt's still very important because it is a function, a lever of determining the final equity value or purchase price of the business. So hopefully you found that useful. I'll see you in the next video where we discuss net debt.